Welcome. I'm here to discuss the solution to problem 6-21 in Chapter 6. On page 270, you'll notice that problem 6-21 deals with the Vulcan Company and their contribution format income statement. The Vulcan Company, we have their contribution format income statement for the 6 months ended June 30th, which shows that they have net operating income of $36,000. Management's not too happy with the company's performance and is wondering what can be done to improve profits. The company is divided into two sales territories, the Northern Territory and the Southern Territory. The book then goes on to give us information regarding the sales and variable costs of the Northern Territory, and from there, by subtracting from the total on the contribution margin income statement given, you can back into the Southern Territory's sales and variable costs. You're given the fixed cost for the Northern and Southern Territory, those of which are traceable. $120,000 traceable to the Northern Territory, $108,000 of fixed costs traceable to the Southern Territory. The rest of the fixed costs are common to the two territories. They also tell us that the company is the exclusive distributor for two products, PACS and TIBS. Sales of PACS and TIBS totaled $50,000 and $250,000 respectively in the Northern Territory during June. Variable expenses are 22% of the sales price for PACS, 58% for TIBS. Cost records go on to show that $30,000 of the Northern Territory's fixed costs are traceable to PACS, $40,000 to TIBS, with the remainder common to the two products. We're asked in this problem in the first part to prepare a contribution format segmented income statement, first showing the total company broken down between sales territories and then showing the Northern Territory broken down by product line. In addition, for the company as a whole and for each segment, we're asked to show each item on the segment income statement as a percent of sales. So in part 1, we have on the screen here, you can see the contribution margin format statement for the whole company given right here. Okay, we're asked to break that down into the two sales territories, the Northern Territory and the Southern Territory. The Northern Territory is really given to us. We're given the sales, variable cost, traceable fixed cost. We only need to do the math to figure out what the contribution margin is, as well as the segment margin for the Northern Territory. We then can back into the Southern Territory's sales and variable cost by taking the total less the Northern Territory. We're told traceable fixed costs are $108,000 for the Southern Territory, and as a result, we have $162,000 of segment margin for the Southern Territory. We're told also that there's common fixed costs for both territories of $150,000, which leaves us net income of $36,000, which is 4.8% of sales revenue. We're asked also in part 1 to break down the Northern Territory between the two product lines, PACS and TIBS. And we can see that, given the information that we're told, there's $50,000 of revenue for PACS, and the variable cost ratio is 22%, meaning that $11,000 of variable cost will be needed to produce $50,000 of sales of PACS. 50 less 11 gives us $39,000 of contribution margin. We are told that there's $30,000 of traceable fixed costs for PACS, leaving us with $9,000 of segment margin for PACS, which is 18% of sales. On the other hand, we see that TIBS, we have $250,000 of revenue for TIBS, with 58% of that revenue being tied up in variable cost, or $145,000. The difference between sales and variable cost gives us contribution margin of $105,000, less the fixed cost of $40,000 gives us segment margin of $65,000, representing 26% of the sales revenue. We later find out that $50,000 of fixed cost is common to both product lines. And at the end of the day, we have $24,000 of segment margin for the Northern Territory. You will notice that this $24,000 of segment margin ties exactly to the segment margin up above in the earlier contribution margin income statement. You also notice that the total traceable fixed cost for the Northern Territory was $120,000. You can see that that is spread between $40,000 to TIBS, $30,000 to PACS, and $50,000 of fixed costs common to both. In part 2 of this problem, you were asked to look at the statement we prepared and show the total company segmented by sales territory. And they ask us to provide what insights we might see by this statement that should be brought to the attention of management. I think you can see that two insights that should be brought to the attention of management are, first, that the Southern Territory is performing at a higher level than the Northern Territory, as can be seen by the $162,000 of segment margin versus $24,000 of segment margin. Okay, you can see that the Northern Territory has a low contribution margin ratio compared to the Southern Territory. And secondly, the Southern Territory, okay, has lower traceable fixed costs compared to the Northern Territory. These are a couple of insights that would be brought to the attention of management. Obviously, we need to dig deeper as to find why this is the case, but certainly management would want to ask these questions to find out why there's such a difference between these two territories. Part 3 of this problem asks us to look at the statement we prepared showing the Northern Territory segmented by product lines, and it asks us what insights revealed by the statement should be brought to the attention of management. When we look at this second contribution margin income statement, two insights should be brought to the attention of management. First, the Northern Territory has a pretty poor sales mix. If you look, you will note that PACS are the product we want to be selling. PACS has a 78% contribution margin. However, we're only selling, out of our $300,000 of revenue in the Northern Territory, only $50,000 comes from PACS. The majority, or $250,000 of sales revenue, comes from the lower product, or the lower contribution margin product of TIBS. So we would say we have a poor sales mix. Secondly, we would note that the traceable fixed costs of the PACS product seem very high in relation to sales. So if you look at PACS, you got traceable fixed cost of $30,000, and that only generates $50,000 of revenue for PACS. Whereas a smaller or a slightly higher amount of traceable fixed cost with TIBS of $40,000 yields $250,000 of revenue for TIBS. This typically means that the PACS product is pretty highly leveraged. You must have borrowed a bunch of money in order to purchase machinery or whatever it might take to produce PACS, which is generating this high amount of traceable fixed cost. What we do see from an upside, though, is that if we can increase the sales of PACS, we would find that we would generate a whole lot of profit, all right, because of the contribution margin being so high. So something management may want to focus on is how to improve the top line of the PACS product line. The other item I would want to note with this Southern Territory is that, the Northern Territory, is that this low contribution margin, or sales, a big amount of sales with a lower contribution product, is probably generating this lower contribution margin of the Northern Territory of 48%. So the fact that we're selling more TIBS than PACS is yielding this lower contribution margin in the Northern Territory. Possibly the company needs to look at why they're selling more TIBS than PACS in the Northern Territory. Obviously there's a better balance in the Southern Territory. This does it for our discussion of the solution to problem 6-21.